could kill, they probably will. In games without frontiers, war without tears. If looks could kill, they probably will. In games without frontiers, war without tears. Games without frontiers, war without tears.
Welcome back, folks. This is the midweek review for the ICT Mentorship March 10th, 2021. We're going to be covering the dollar index, Eurodollar, cable, and we're going to be reviewing the homework on Aussie dollar. All right, for the remainder of the week, this is your economic calendar. Tomorrow in the New York session at 7:45 a.m., Eurodollar has a monetary policy statement and main refinancing rate. There's going to be a lot of volatility around the euro at that time. 8:30 a.m. ECB press conference. Then we have the bond auction at 1 p.m. for the US dollar. And then Friday, 8:30 a.m. Canadian dollar high impact employment change and unemployment rate. All right, here's the weekly chart. Before I get into it, I'm just going to go through it smoothly. I'm not going to be adding any kind of additional lectures or any kind of build up around anything. The reason why I need time tonight and tomorrow, so we'll be doing a real short and sweet daily log entry tomorrow as well. This weekend, you're going to have a very long video. Okay, so the weekend commentary will, like I said, bring in that level of teaching that I said was going to come, and a lot of the point to where it's going to go to next, that's going to have to take a back seat for a couple weeks, maybe for a month or two, because I have to get the content out to you. And if I spend all my time making these types of review videos or analysis videos, while that's great and all, and you probably enjoy it, I'm never going to be able to get to the teachings. So I want you to understand that we're doing in-depth lessons that's going to be modular, and at the end of the year, you'll have segments that you piece together, and it's essentially the ICT manual. So you will have new watermarks this weekend also, so we're going to be splitting the groups once more, so you'll see a different watermark in your respective groups. Real quick, do not talk about your watermarks. Do not share your watermark in the forum. This is the reason why I do not allow editing or deleting your posts, because if there's any conversation within the community about what watermark you're using or what your watermark is for your group, I will ban you. Okay, I'm doing this for a reason. I'm not doing it because it looks cool, because it's really annoying to me, but I have to do it. I've already popped someone yesterday, and I'm walking around the house like a peacock because I did so. Okay, I feel very good about it. I don't feel any remorse for them. I have several other people that I'm working with that are trying to get other members in here that are doing this exposed, and I'm going to give them your seat. It's going to happen. So with that, the weekly dollar index, you can see we have traded up into this bearish order block. So it might be a matter of the market having reached up into this level here, all this a wind up into a likely drop down into the sell side liquidity on a longer term basis. We'll see. All right, here's the daily chart for dollar index. Here's that volume imbalance I said I would share with you when we got to the midweek review. So there is no bodies in here. Yes, there's one small one in here, and it crosses over here, but my attention goes right there. If you extend that from the opening here and the close of that candle, push it out in the future, touches it perfectly here on Tuesday, and then trade softer. We have a breaker here, so if we do come back down in, we might get an institutional order flow entry drill here that overlaps with the breaker, so that might give us a little bit of a chance to find some support if there is any. But as for right now, we'll have to see what we get in regards to the next direction. It's already moved a nice swing here, and whenever it hits a premium array like this, we have to take a step back and consider if we're going to consolidate or reverse. not just always continue in one direction. All right, here's the dollar index on the 60-minute chart or 1 hour chart. Look at the precision of that. The body's hitting it and just repelling away. It's just beautiful. Like, that is beautiful. That's what the boys from Goldman Sachs say doesn't exist, that technical science. Here's the daily breaker levels I was showing you on that daily chart before dropping down to the hourly chart. We have a buy side imbalance, sell side inefficiency here. So as I mentioned, we might see it want to dip into that. I don't know personally if it's going to go here and rally. I'd like to see it wilt because we've already traded back up into a premium on the daily chart. And if the dollar is going to resume going lower, this is a nice framework to do so. Fair value gap in here, extending out in time. You can see we trade up into that as well. And that bearish order block, which is that level right here. So fair value gap, bearish order block on the daily, optimal trade entry from swing high to swing low, OTE, fair value gap, sell side imbalance, buy side inefficiency in the form of a fair value gap. Just a brilliant opportunity to see it wilt and go lower. Sell side imbalance, buy side inefficiency again, trades up into a bearish order block there and starts to sell off once more. So we do have a small little pool of liquidity right over here on non-farm payroll. So think about it like this. I've hinted at several times now how non-farm payroll generally tends to create like the Judas swing for the month. Okay, so what have we seen? A rally up after non-farm payroll, and then now we're not seeing anything on the upside. So we'll see if it wants to continue and drive back into rebalancing this area here on an intermediate term basis. 15-minute time frame, you can see here on the midnight hour. We trade up into optimal trade entry from the low to the high, right in here. And notice the high forms ahead of London Open. This is the only jawboning. You knew it was going to come. This guy cannot say there ain't going to be any jawboning and then deliver without jawboning. All right. You know that daylight savings time is upon us. Okay. And the question is going to be, how do we change our kill zones? How do we do this and how do we do that? That's the reason why I've been giving you these very specific times on the kill zone. After we go into daylight savings time, I'm going to show you the actual kill zones that I use, which specifically are not these, but they will also show you how you won't have to worry about moving kill zones around, okay? Or worrying about daylight savings times, because I personally don't. All right, so that's the only extra stuff, extra talking in the video. So this shaded box area here, that's the optimal trade entry from high to low. And we trade up into that, and it's ahead of London Open. So it starts to sell off, comes back up in, sells off one more time, SIBI, right here, with optimal trade entry again forming ahead of New York Open. Now you see what's happening here? Everything's starting to get a little disjointed because of that element of time, okay? It's messing with all the traders because of daylight savings time. Some countries don't even use daylight savings time, but we're getting into that early spring effect, okay, where everything starts getting weird with the timing. And there's no reason to worry about that. Once we get into daylight savings time, the kill zones I'm going to show you just completely remove all the uncertainty, okay, and you just operate in them. But optimal trade entry here sells off. Smaller one in here if you want to look at a 5 or 1 minute chart in here. That's a nice optimal trade entry there in New York. Sells off and drives under the sell side liquidity that rests below these relative equal lows. Deep retracement, bearish order block, another optimal trade entry in here for London close. What's the higher time frame bias now? We hit that premium array up here, and I said we hit it and we started to move away. So what's the bias? Higher time frame now has moved to likely bearish because we hit a PD array. If we see indications that want to sell off, higher time frame, London close tells you that directional bias. In sync, trade with it going lower. Okay, it doesn't necessarily have to take out that low to be profitable. And again, we don't trade dollar index, but just for bias purposes only. All right, euro dollar is our weekly chart. This is one of the things I wanted to mention. We have this consolidation in here, and then we had this run up. We came back down into this consolidation. Now for this pair to want to drop lower, this is a high resistance liquidity run. So while we do have relative equal lows here, it could go lower and it could go higher in the dollar. It's very difficult for it to do so in an environment like that. It spent a lot of time. Folks, these are weeks, okay? These are weekly candles. It spent a lot of time consolidating in that area, then ran up, and we're just now coming back down into it. And we never came back above for the buy side liquidity here. I'm not saying it must do it, but to me, we're at that point where, you know what, we could be possibly creating some intermediate term low. Daily chart on euro dollar. We have a breaker here, extending out in time. We traded into that, and we have a small little fair value gap. Now recall what I said on, if I'm not mistaken, the weekend review. Was it the weekend review? I'm not sure. I know I said I wanted to see like this area in here where we had an institutional order flow entry drill, this pattern here where it goes up above the previous high in here ahead of a gap. That little movement here and then sell off, I said I wanted to see it form between this low, and it should offer some kind of a imbalance. It did. So do we punch up into that and then sell off and go deeper into this consolidation? Maybe. But if it does something like that and it sells off and then rejects that, wow, then my attention goes right up here. But for right now, we have to contend with all this consolidation, and what we have in this small little imbalance, you know, that's the only working framework we have for right now. Euro dollar hourly chart. We ran buy side liquidity here. I mentioned that we would likely see on yesterday's daily log entry a high ran out. This high in here. And we dip down into the buy side imbalance, sell side inefficiency, consequent encroachment, midpoint of the gap. Gap is this low to this high. Half of that projected in time, trades there, rallies. There's an optimal trade entry here too if you want to look at it on a lower time frame. Then rallies up, another optimal trade entry. And rallies again, and up here's where I posted in my YouTube commentary or community tab, Pay the Trader. And this was a classic London session run. Came back down in, order block, and rallied one more time. So it looks to me like it wants to take out that buy side liquidity pool at 119.30 to 119.35. So we'll see what we get there. Euro dollar 15-minute time frame. London open kill zone, optimal trade entry. Runs here. High before New York, retraces back down into order block. Buy side imbalance, sell side inefficiency. Perfect, classic. This right here, folks, this is the pattern that I promise you the majority of us, once we're done with this, and we've been a community for a number of years, I would like to do a meet and greet, something like in Florida or maybe Hawaii, one of the two. It depends on what everybody wants to do, but I would like to meet at a location like that. And there's going to be a lot of you, okay? Maybe not all of you will come, and that's fine, but I promise if we all meet and I say, okay, what pattern did you settle in on? Now, this is not to discourage you if this is not what you've grown to like or want to pursue. And I'm just reminding myself now mentally that I'm jawboning. But I can't help it, okay? I can't help it. So if I ask everyone collectively what pattern they have went to as their bread and butter, this is that pattern probably for most of you. If not, it probably will. Okay, it's just so easy. It's very, very easy to see. It's easy to spot. The framework is just textbook ICT. And you have the London low. It rallies up, creates a high prior to New York open, and it retraces back down into clear, obvious 2 down closed candles. That's one consecutive order block. Extending out in time with a gap, this high to that low. And then you have another optimal trade entry there, right in the heart of New York kill zone. So between 7 o'clock in the morning and 9 o'clock in the morning, New York time. That buy sets up a run to a previous high over here. That is such a easy trade, and it happens every single week. So if you do just this one pattern and that's the only trade you take, you're a success. You graduated and you've done exceedingly well in my eyes, because you're able to find that one pattern that repeats for you. Over time, you're going to realize that this pattern repeats on all time frames, and you can use it to frame in any situation, not just a 15-minute time frame. It could be a 1-minute chart, and this could be a 10-pip scalp. It could be a 5-minute chart, and this could be a 20-pip scalp. This could be an hourly chart, and it could become a 20 to 40, maybe even 50-pip run. And a 4-hour chart, it could be 50 to 100 pips or more. So all of this pattern here, this right here, okay, if I was to say, all right, I'm going to strip it down, I'm going to teach one pattern, I'm going to teach everybody to do the same thing, this would be that pattern. This would be it, because that's what I've essentially done on YouTube. This is the pattern that I teach over there, and it's gold. It is absolute gold. You can print as much money as you want with this pattern. It's that powerful, but everybody wants to see, something extra, and they don't want to spend the time in understanding the order flow and when to look for it. That's the hard part. But if you can see this pattern, it makes sense to you. That's the beginning. That's the beginning of carving out your specific niche and model. And once you adopt that, it's just, man, the sky is not the limit. London crease to low, rallies up, optimal trade entry in New York Open, runs above this old high, trades back down one more time into a rejection block. Okay, this low gets swept by this one, extending in time. Here we go, rallies from there, and it just simply looks like it wants to go higher. So we'll see if it wants to get into that 119.30, 119.35. It could go even more than that, but that's what I'm looking for right now. And you're probably thinking, well, it's not doing me much good. Well, I'm not a signal service. I'm showing you how to read it. All right, pound dollar. This is our weekly chart. And I wanted to see it completely close this in, but because we didn't, that to me is information that I like, because if it's not wanting to go down there and we've already dipped into it, this may be a weekly chart institutional order flow entry drill. And we could potentially revisit this area up in here, which is consequent encroachment, or the rejection block here, extending out in time. So that's what I'm looking at on the weekly chart. Remember, I've been very cautious with this pair, and this might not have been all they're going to do in cable. I mean, they could do something crazier than that. All right, and there's the imbalance I said we wanted to see, or I wanted to see. Let's take ownership of that, Michael. The daily chart did not get any deeper than just touching the top of it. And then we have the structure here. So this to me has my interest. So we have relative equal highs coming off of a higher time frame discount array. And it certainly looks like it wants to go up there. My only concern is we just stay sideways. And if we really break lower with a big, large down day tomorrow, then go back to thinking this, okay? But right now, gun to my head, I think that it is absolutely likely to see it trade up back into this, okay? And that's assuming that the dollar does, go lower, expanding lower. All right, 60-minute chart on cable. We have a sell side imbalance, buy side inefficiency, buy side liquidity pool that was swept here today. Trade back down into another buy side imbalance, sell side inefficiency. Closes that in and rallies. Rejection block in here. Runs higher. All of this business is from yesterday's daily log entry, so it's not important to mention again. Dropping into the 15-minute time frame, you can see that we did again create low of the day ahead of London Open kill zone. Price rallies up, trades above the rejection block that's not on the chart. I apologize, it should have been there. Trades lower, back into the order block here. And again, notice the timing. It's just ahead of New York. So maybe some of you have been noticing there's these moves that are they're a little early. They're just ahead of what we would normally expect. That's okay. Trust me, it'll all work itself out, okay? But I need you to understand, and this is why I say to all of you, why are you talking about these times when you talked about these times over here? because I'm teaching, and there's a huge number of new students that came in, and they need to know the right perspective and not ask me these types of questions when they're in month 6 or 5. Okay. Plus, most of you went too fast in the videos anyway, and you probably only retain this. So you're already seeing the discrepancy with these specific kill zones. Okay, these very specific kill zones are ones I started with early on in baby pips, because I was trying to, at that point, work you all through the natural progression of what you're learning here. But people abused it, so I had to create this environment. So, and they're abusing that too. So anyway, low before the New York Open, runs above, runs out this high here, and this high over here. So buy sell liquidity has been tagged here and starts to decline back into a bullish order block in London close. What's the higher time frame bias? If it's not wanting to go at imbalance on the daily chart, it's rejecting. So that means the daily bias for daily is bullish short term. So that daily bias, you can get in sync with that in London close time frame, and here you go. Ran out a higher high, and there it is. We're still framing everything with the midnight to noon for scalping only. It's not long-term position trading. It's not swing trading. So again, don't let this throw you off that, well, you have to stop at noon. No, for scalps, it's better for you to do that. Operate between midnight and noon. There's lots of framework in there that you can use, but for now, hold off on your questions, because there's a lot of you that are asking questions about, why are we using this time? Why did we drop from 2 o'clock? Because I'm showing you the difference between finding the daily range and what will eventually go into true day. True day is a very specific beginning and end, and that's the markings, if you will, for my daily range. But you can frame this from a intraday scalper's mindset like this. You have a 12-hour window. Within those 12-hour windows, you have several hours each day that you want to focus on. And if you don't get a setup, you don't get a setup. You don't force it. And I'm already talking more than I want. All right, it brings us to our homework. Okay, this chart should look exactly like it did yesterday. So I gave you homework, and it was to find a bullish breaker, redelivered rebalance, rejection block, optimal trade entry. And I said I would review it in the midweek review or commentary. Well, here we are. So I'm going to go in the list order. So the first thing is the bullish breaker. That bullish breaker is seen here. Highest up close candle, low to high, extending in the future. Okay, that's your bullish breaker. The next thing is the redelivered rebalance. That is right there. Now what it is we have this candle going up. It comes off the high and creates a wick. The next candle we have trades lower and then runs through the wick and closes above. So we had an imbalance that was redelivered and rebalanced. So we don't use this candle at all. We ignore this candle. So with that in mind, what are we framing? We're framing this candle's high right here and this candle's low. There's your redelivered rebalance. There's 2 different kinds of redelivered rebalance, but this is one that you're being shown here. And then now the next thing in the list is number 3, the rejection block. That's here. So you have the lowest down close in this swing here prior to that run on the sell side liquidity, resting below these relative equal lows, runs through it and higher. Now, some of you may have used this one over here. And essentially, I guess that wouldn't be a wrong answer, but let me tell you the reason why I'm picking this one, okay? This low and these lows are essentially the same thing. So we have sell side liquidity resting below that. I'm adopting this one because it's slightly lower than that one. That's the only reason why I used this one. But if you used this, that's fine. There's nothing wrong with that one, okay? But this is why I did this one, because it's slightly lower than that one, and we had relative equal lows here. So you have to think about it in context. It stopped as support, couldn't go lower, stopped as support, and then ran through it. So the lowest down close in all of this consolidation, that's what I'm focusing on, okay? That's the narrative behind why I selected it. Now, it didn't get down into it, but I would have expected, if we were watching live price action, this could have easily went down into that. Okay, could have easily hit it, and then I would expect it to reject. What made it unlikely, but still possible, was that you had this order block here, and it extended as far as that low. So this down close candle, kind of like a wild card, it could have hit just the order block open here and never went even as low as that. But we went just about halfway of the body of that down close candle, and then it rallied. But that's the rejection block. And fourth is optimal trade entry. So you have that low to high, back down to the low. So there's your optimal trade entry. And now let's take it over to the Australian dollar. With everything that I prompted you here, let's see what it looked like in moving forward. All right, here's that breaker, extended out in time. Optimal trade entry here, the rejection block, redelivered rebalance inside the breaker. Perfect. Isn't that crazy? Low to high. What's it going to run out? The relative equal highs here. Okay. More specifically, these. Okay. Whenever you look at this high and a higher high, I don't like to go that far back. I'm going to use the framework with this high to this lower high, because this is a low resistance liquidity run signature, and you'll learn about that as you progress more into the content. But this high had buy side liquidity resting above it, and you can see they punched into that there. But this right here is also an optimal trade entry. All right, here is the breaker, these two levels here, extending out in time. And this here, this shaded area, is optimal trade entry. This is 79% retracement level and 62% retracement. And it's based on this low up to this high, dropping down into the 10th at midnight, just after midnight, creating a low of the day inside of redelivered rebalance here. And while this chart is a little bit cleaner, I'll talk about this area again. Think about what we're seeing here. We're seeing this run up, and in the next candle we drop down and run up. So it's delivered another level of buying. The next candle, we run through this wick. See how we didn't have a wick here at all? It's a blunt-ended candle. So this right here, this candle creates a run, and then it comes off the high, leaving a big wick. No, I shouldn't say big wick, but it leaves an imbalance there. The next candle opens, trades down, and then runs through this candle's high, and then closes here. So we redelivered this imbalance. So take this candle completely out. Take it out. Okay. And you look at this candle's low and this candle's high. And there's your typical fair value gap. But what makes it more powerful is the fact that we have redelivered rebalance, and you need to frame it back the same way the algorithm would do. Another way of looking at this would be to look at this candle's low and this candle's high, and both these candles be completely removed from the discussion, and even this indecisive candle, because it's all back and forth delivery that's overdone and redelivered with this candle here. So you can take that low to that high, and that would be just another level of redelivered rebalance. And if you have that low here, we start to trade into it there. Small low consolidation, and dips into exactly that one. Okay, so I tossed that in there for no extra charge. I promise you we will talk more about redelivered rebalance, because it's a topic that needs to have multiple discussions, and other things that you'll learn I'll bring into to help you understand it more. But that's going to be it, folks. I will touch base with you tomorrow in a very, very short video. I promise it's going to be absolutely short, because I have work I have to do to prepare for your weekend lesson. So until then, be safe.